And it looks like the sluggishness has creeped back into the market, with the Nifty and Sensex giving off those opening gains. As you can see on your screens, it's been a one-way decline for the markets, and now the Nifty has in fact slipped below the 10,500 mark, though of course there's a bit of recovery attempted just in the last couple of minutes in the markets. But let's talk about that and much more with Rajat Jain, Principal Mutual Fund. He's joining us right here on the show. Mr. Jain, good morning. Thanks so much for joining in on ET Now. We're at a very interesting juncture in the markets where on one side, we have corporate earnings, which seem to be about okay. Most were, of course, pinning the improvement in the markets of sorts to come in on that. I wouldn't say they've been outstanding, but they haven't been bad either. They've just been about, on a scale of 1 to 10, I say maybe 6 or 7. But on the flip side, you have the macro situation that is deteriorating. And of course, taking charge of that, it is crude prices. So how exactly is the India story placed right now, with micros maybe showing an inch or two of improvement, but macros definitely not supporting that?
I think you absolutely laid out the two sides of the picture, the macro and the micro. Now, India really at the end of the day has been always a strong micro bottom-up story, and I think the numbers, as you just said, actually corroborate the strength in the bottom up. If you look at the volumes, for example, from consumer companies, be it two-wheelers, be it paint companies, be it FMCG companies, I mean the volumes per se themselves have been very, very strong. And even anecdotally, the evidence that the companies talk about on the earnings call is that, especially rural India, they see earnings, at least the volume growth to sort of remain strong there as well. However, macros, as you did say, on account of oil, on account of likelihood of a higher current account deficit, potentially a higher fiscal deficit, probably as revenues do pick up, but not the way we thought they would. So there are issues on the macro, and what macro really does is it doesn't really impact the bottom line of the companies directly, but what it does do is impact fund flows. People. Like for example, if rates go higher, then other asset classes do become more attractive. Equity is not so attractive potentially for the near term. So in that sense, it does have an impact. So having said that, so I think this year is going to be it's going to be a challenging year on account of both macro and micro factors. And we really think this calendar year 2018 probably is going to be a low single digit sort of a return for equity markets. But having said that, if you look at the valuations per se, and the market's probably 18 odd times FY20 earnings, so we are not cheap, but we're not very expensive either. So I think if you are playing in equity markets for the next 3 or 4 years, I think it's still a good place to be.
No, most definitely. But how do you size up the opportunity in mid caps and small caps?
I really think, this year potentially on account of volatility, on account of some sort of flight to higher quality names, some sort of movement to larger cap names, potentially large caps would do well this year. I think that is the consensus in the market. But we find enough companies in the mid cap space, at least in the large mid cap space and across mid caps as a whole, where earnings can grow substantially over the next 3 to 4 years. So we think over the next 3 to 4 years, mid cap should do better than large caps, but clearly in the near term, that is the next 12 to 15 months, possibly till the elections next year, on account of all these news heavy volatile times, we could have large caps doing better, but I think over the next 3 to 4 years, I think mid cap should do better than large caps.
I think, Mr. Jain, you're some of the few people who have been saying that mid caps will do better than large caps, especially with the, the carnage that we witnessed. So, do you believe that this slip that we have seen in the markets, to put it lightly, of course, in the mid and the small caps, may have actually cleared out the froth in valuations for a lot of these companies? Take, for example, some of these NBFCs, consumption names, of course, still are at their all-time high levels, and with the recent numbers as well justifying those valuations. But for some of these mid and small cap companies, do you think that this fall may have just cleared up some of the froth?
Truly, I think that is part of the story. Clearly, I think the valuations certainly have become much more reasonable. Also, many companies are sort of restructuring their operations. I mean, paying down debt. So while even if the enterprise value remains the same, that value does move to the equity piece of the equation from the from the debt piece. In many cases, I think they are probably going to see better margins going forward. Plus, as you rightly said, valuations have become attractive as well. So if you look at the pure earnings numbers per se, I think there are a fair number of companies where earnings could grow something like 15 to 16% compounded. Of course, not evenly over the next 4 years, but probably CAGR of 15% for the next 3 to 4 years, which I think is reasonable, and with in some cases with decent valuations. So we really think, coming from both these factors, cheaper valuations compared to where they were earlier, and the fact that earnings are likely to grow, we should see them doing well.
What do you make of PSU banks and what SBI has reported today? Could this be a new chapter in their earnings trend line?
Yeah, I think, this question, I think on your channel, we have, the last few times I've been with you, we have said in the banking space, we are not zero, in the PSU bank space. However, we are very focused on the large, well-run names, people who have more or less close to cleaning up their balance sheets, as we saw certainly State Bank do come out with a good set of numbers actually yesterday. I mean, forget the loss, but going forward, they seem to have cleaned up substantial part of the balance sheet. So I think there are 3 or 4 big trends playing out here. See, one is there's going to be a consolidation among the banks, because traditionally, if you see, Indian corporates tended to have a large number of banks with whom they would have relationships. As a number of the PSU banks go into the PCA category, they clearly aren't going to grow their books, and potentially they are out of the equation as far as lending movement to corporates is concerned. Secondly, in terms of capital, the idea is that capital is not going to be so easy to come by, so few people really will have the wherewithal to grow. So the large PSU banks and select private sector corporate banks clearly would fill in the picture. And also, if you look at the companies that have gone to the NCLT, traditionally they would have again had say 25, 30 kind of relationships. As they do come out, they come out with stronger hands. I mean, the new owners are stronger people, and they would again consolidate those relationships with the fewer banks. So I think the corporate banks, really will be few people who can grow, and I think which I think the large PSU banks do come in. So it's always been, it's not been PSU versus private, it's really been banks which are well run, have adequate capital to grow, and which certainly I think should do well over the next 3 to 4 years.
It's great to have you on the show. Thanks very much for taking out the time to speak with us today. Rajat Jain, their Chief Investment Officer at Principal Mutual Fund, for our viewers.